Welcome to This Explainer. Let's be totally honest for a second. Are you sick and tired of acting like a reactive gambler in the markets? Well, today, we're going to completely transform how you operate. We're turning you into a cold, calculating risk manager. We'll be taking the mathematical edge of COT data, that's the commitment of traders, and pairing it with absolutely unbreakable profitability rules. By the end of this, you're going to have a rock-solid step-by-step framework for survival.
Here's our game plan for today. Number 1, the profitable trader mindset. Number 2, calculating perfect position size. Number 3, setting daily loss limits. And number 4, verifying your COT data step by step.
All right, let's kick things off with part 1, the profitable trader mindset.
Okay, think about this quote for a second. A winning trade that broke your rules is a bad trade. I know, that sounds completely backward, right? I mean, you made money. But here's the dangerous reality. If you break your rules and win, you are literally just reinforcing bad habits that will eventually wipe out your account. A losing trade that followed all your rules is actually a good trade. You need to keep a journal with 2 columns, and the first column simply asks, did I follow my rules? You have to completely ignore your profit and loss when you're evaluating your discipline.
Now this right here perfectly illustrates the difference between amateur failure and professional consistency. On the left, we've got the psychological death spiral. And hey, it's not a personal weakness, it's just basic biology. After 2 consecutive losses on perfect setups, your brain panics and actively sabotages you. You start doubting the data, widening your stops, and doubling down. But professionals, they use a 20-trade moving average. You cannot possibly know your true win rate after just 5 or 10 trades. You absolutely must wait for at least 20 trades to evaluate a strategy, and a full 50 trades before you even think about changing it.
Moving right along to part 2, calculating perfect position size.
Listen, you can never, ever just guess your position size. It absolutely requires a strict mathematical calculation every single time. So here's your new best friend. Take your total account value, multiply it by your risk percent, and then divide that number by the exact distance between your entry price and your stop-loss price. What this does is dynamically adjust your position size. You decide the risk first, and then the market dictates the size.
Notice how your risk percentage actually needs to mathematically scale down as your account grows. This is crucial. If you're working with a small account under $10,000, you're capped at a strict 1% maximum risk per trade. For a medium account, up to $50,000, you drop that to between 0.5% and 1%. And for large accounts over $50,000, you're only risking a tiny 0.25 to 0.5%. This kind of structural tiering is exactly how you protect your wealth as it accumulates.
And that brings us to rule number 1 of risk management. Lose small, win normal. You've got to establish a fixed minimum risk-to-reward ratio before you even think about clicking buy or sell. The absolute baseline minimum is 1 to 2, meaning you risk $1 to make 2. If you map out your trade and that take-profit distance is not at least twice the stop-loss distance, what do? You walk away. Period. No exceptions.
Which brings us nicely to part 3, setting daily loss limits.
The magic number here is 2x. Your maximum daily loss limit needs to be exactly twice your per-trade risk. So if your calculated risk per trade is 1%, your maximum daily loss is 2% of your total account. And here is the real kicker. This must be hard-coded into your trading platform. When you hit that limit, the platform literally locks you out. Absolutely no manual overrides allowed, because you simply cannot trust yourself when you're on tilt.
To put that into perspective, look at this stark contrast. This is why we are so ruthless about that 1% limit. Let's say you had a terrible losing streak and take 10 consecutive losses at 1% risk. Your total drawdown is 9.6%. Yeah, that stings, but you can definitely recover from it. But if you get reckless and risk 5% per trade, those exact same 10 losses result in a massive 40% drawdown. That's an account destroyer. Risking just 1% is what keeps you in the game.
To further protect yourself from that psychological death spiral we talked about, you must implement the 3-strike rule. 3 consecutive losing trades means your decision-making is biologically impaired at that moment, so you stop trading for 2 full calendar days. Hit 5 consecutive losses, you stop for an entire week. And please, whatever you do, don't just trade tiny position sizes to try and gain confidence back. Step away completely and clear your head.
And finally, part 4, verifying COT data step by step.
Let's map out your new, highly structured weekly execution workflow. This is what removes all the emotion and creates pure consistency. We're going to step chronologically through this timeline, starting from Friday's initial data drop, through your weekend prep, all the way to actually executing the trade midweek.
So the timeline kicks off on Friday when that CFTC report drops. Step 1, you export the disaggregated COT report for your specific market. Step 2, convert those raw net positions into a positioning percentile. You're hunting for situations where the momentum crowd is stretched beyond the 80th or below the 20th percentile, and you're calculating the weekly delta to spot any momentum acceleration. And finally, Step 3, record the open interest just to verify if new money is actively entering that trend.
Then comes Saturday, which is purely for preparation. Take the markets you flagged on Friday and cross-reference them with the upcoming economic calendar. You're actively identifying high-impact events, things like central bank decisions or major crop reports that could act as catalysts for a news failure. Then, map your charts. Clearly mark structural technical levels, your swing highs, swing lows, and key round numbers. You are carefully, methodically building a trap.
Once the week opens on Monday, patience becomes your absolute greatest asset. From Monday through Thursday, you monitor those flagged markets for the specific news events you noted down. You are looking for the Shapiro adaptation pattern. That's when the news hits, price makes an initial logical move, and then does a full reversal within 60 minutes. But wait, before you execute anything, you must confirm the technical violation. Price has to close beyond that structural level you drew on Saturday.
Think of this whole process as a giant filter. Your true superpower in the markets is your ability to say no to 90% of setups. Multiple confirmations have to align perfectly. The momentum crowd needs to be at an extreme. The weekly delta has to be above 90. Open interest must be rising. And critically, there can be no other major news events in that sector for the next 72 hours. If even one of these structural filters is missing, it doesn't pass the test. There is no trade.
So before you take your next entry, I want you to look at your checklist, double-check your sizing, review your charts, and ask yourself this one ultimate question. If I followed every single one of these rules for the next 100 trades, would I be profitable? If you're using the COT framework, the math says yes. Your survival doesn't depend on somehow magically predicting the future. It depends entirely on your submission to discipline. Will you be the trader who breaks the rules for a quick thrill, or the professional who follows the math to lasting profitability? The choice is entirely up to you.